Inheritance tax, also known as IHT, can significantly reduce the wealth you pass on. Without proper planning, your loved ones might face unexpected financial burdens. IHT is the tax payable on the estate of a deceased person, including property, money, and possessions. There's normally no IHT to pay if either the value of your estate is below the current £325,000 threshold, also known as the nil rate band, or if you leave everything above the £325,000 threshold to your spouse, civil partner, a charity, or a community amateur sports club. Why plan for inheritance tax? Planning ahead helps you protect your legacy by reducing unnecessary tax and making sure your wealth is passed on as you intended. It also helps maximize how much you can transfer to future generations by using exemptions and tax-efficient strategies. A clear plan can minimize family disputes and delays during probate, making the process smoother for everyone involved. And most importantly, it gives you peace of mind knowing your loved ones will be looked after and your legacy is secure. While the prospect of IHT may seem daunting, there are various reliefs and exemptions available to mitigate its impact. From lifetime gifting and trust structures to the use of tax-efficient investments, careful planning can help minimize the tax burden on your estate while ensuring your loved ones receive the inheritance you intended. The nil rate band is a threshold set at £325,000, below which no IHT is payable. Married couples and civil partners can combine their nil rate bands, effectively doubling the threshold to £650,000. This strategy can significantly reduce potential tax liabilities. The residence nil rate band offers additional relief when passing on a main residence to direct descendants such as children or grandchildren. It provides an additional nil rate band where individuals who died after 6th of April 2017 owning a residence which they leave to direct descendants. Currently, the maximum R&RB available is £175,000. The threshold is frozen until 2028, meaning planning now is vital to avoid future tax burdens. However, the R&RB does come with conditions and so may not be available or available in full to everyone. If an estate is worth more than £2 million, the residence nil rate band is gradually reduced by £1 for every £2 over the threshold. Special rules also apply if someone downsized, sold, or gifted their home before they passed away. To learn more, visit gov.uk. The effect of tapered R&RB is illustrated on this graph, where estates valued over £2 million for a single person. Business relief is a tax relief designed to help businesses pass through generations without triggering inheritance tax. If qualifying assets are held for at least 2 years and still held at death, up to 100% relief from IHT may apply if all conditions are met. However, from April 2026, changes to business and agricultural property relief mean only the first £1 million of combined assets will qualify for 100% inheritance tax relief. Any value above that will receive just 50% relief, leaving the other half potentially taxable. These proposed changes will also affect shares such as AIM shares, which currently get 100% relief. Shares in companies not listed on a main stock exchange, such as those on the alternative investment market, may qualify for 50% business relief under inheritance tax rules. But this relief only applies to certain business-related assets. Not all AIM shares are eligible. When an asset qualifies for 50% business relief, it's effectively taxed at a reduced rate of 20% rather than the standard 40% inheritance tax. The $1 million allowance is expected to apply across your lifetime and will cover eligible business and agricultural assets, such as your estate at death, gifts made in the 7 years before your death, and any business or agricultural assets transferred into a trust during your lifetime. Each tax year, you can give away some money or possessions free of inheritance tax. This includes gifts to your spouse or civil partner, or if you'd like to leave money to a charity. How much is tax-free depends on which allowances you use. Everyone has an annual gifting allowance of £3,000 each tax year, which can be carried forward once, allowing you to gift up to £6,000. You can also give unlimited small gifts of up to £250 per person, as long as they haven't received part of your annual allowance. These gifts are exempt from inheritance tax. Gifts between UK spouses or civil partners are completely exempt from IHT, as well as on gifts you give to UK charities or political parties. You can give tax-free wedding or civil partnership gifts of up to £5,000 to a child, £2,500 to a grandchild or your future spouse, and £1,000 to anyone else. These can be combined with your £3,000 annual allowance to make a larger gift in the same year. The normal expenditure out of income exemption lets you make regular gifts from your surplus income without incurring inheritance tax. The gifts must be made routinely from income, not capital, and must not affect your standard of living. It's a powerful way to pass on wealth during your lifetime while reducing future tax liabilities. Non-exempt gifts made within 7 years of death may be subject to inheritance tax. If the total value of these gifts and the estate left to non-exempt beneficiaries exceeds the nil rate threshold, a 40% tax may apply. This rate can reduce to 36% if at least 10% of the net estate is left to charity. When you make a gift above your exemptions, it's called a potentially exempt transfer. If you live for 7 years after giving it, the gift falls outside your estate and is free from inheritance tax. This rule is a key part of IHT planning and can significantly reduce tax liability on lifetime gifts. If you pass away within 7 years of making a gift, your heirs may face inheritance tax. However, the tax rate reduces the longer you live. This is known as taper relief. Trusts can be a powerful tool for protecting family wealth and reducing inheritance tax across generations. How they're taxed depends on whether the beneficiaries are fixed or discretionary. Popular options like loan trusts and discounted gift trusts help preserve your estate and support long-term planning. For more on how trusts work, speak to your advisor about our 2025 Trust Guide. Tax-efficient planning helps minimize the impact of inheritance tax by making the most of pension benefits and life assurance. Pensions are a key part of retirement planning and, until now, have typically fallen outside your estate for IHT. But from April 2027, unused pension funds may be included in your estate and become subject to IHT. This change makes it more important than ever to review your pension as part of your wider estate plan. For the best outcome, speak to a financial advisor to ensure your strategy is aligned with the latest rules. Inheritance tax is due just 6 months after the month of death, often before probate is granted. This can delay access to the estate and may require executors to borrow or use personal funds to pay the tax. Certain assets like property or shares can have IHT paid in installments over 10 years, though interest applies. A life assurance policy placed in trust can offer a solution, paying out directly and tax-free to cover the IHT bill, avoiding delays and helping beneficiaries manage costs without added stress. We've also created a helpful inheritance tax checklist to support your planning. Speak to your advisor to request a copy and take the next step. It's essential to seek professional advice tailored to your circumstances, as tax legislation can change over time. Stay informed about changes in tax legislation and thresholds. By doing so, you'll ensure your estate plan remains effective and aligned with your goals.